the meeting and receive apologies. Do we have apologies?
Yes, Chair. Apology from Mr. Likhanyane. He is attending the IDA committee, and then Mr. Beasley is attending SCOPA. Thanks, Chair.
Okay. Those are the apologies. And let me, Honorable Kaleka.
Chair, by 12, I will be driving to Parliament, but I will still be connected in case maybe I get disconnected if we are not finished by 12. I'm attending physically this week. Thanks. Thank you.
Okay, thanks, Honorable Kaleka. Let's proceed. Let me welcome everyone. It's my pleasure to extend a warm welcome to all of you who are here in this platform, in this meeting. I would like to begin by welcoming the honorable members of the Finance Committee, Standing Committee. Your presence is invaluable to our discussions today. To the committee support team, PBO, Parliament communication staff, and legal team, your expertise and dedication are crucial to the success of this meeting, and I'm grateful for your contributions. To our stakeholders who have taken the time to join us today and make submissions on the taxation bills, your input is highly appreciated, and we look forward to engaging with your perspective. I would also like to welcome the media who play a vital role in keeping the public informed about our proceedings. And to all and sundry who have joined us today, you are welcome here, and we appreciate your interest in our work. Thank you, and let's get started. The first to make a submission is the SA Institute of Taxation. Over to you, SA Institute of Taxation. Alan, we're allocating 15 minutes.
10 minutes each presenter, Chair.
Or today's 10 minutes. I will request stakeholders to time themselves. You have got a computer and a phone in front of you. So there is a timer on the gadget. So the moment you start, 10 minutes, then it goes down like that until you are left with 1 minute, so that I don't disrupt you at the end when you have to make concluding remarks. South African Institute of Taxation, let's start. There you are. It's 9:05 now. Over to you.
Thank you. Thank you, Honorable Chair. I hope I'm audible.
Yes, you're audible and we can see your presentation.
Thank you very much. Good day to yourself, honorable members of the Standing Committee of Finance. We'd like to thank yourselves as well as the stakeholders from National Treasury and SARS for the opportunity to engage in the 2025 draft TLAB and TALAB. We appreciate that it's been quite a tight fit year, but notwithstanding that, we appreciate the inclusive consultation process. We appreciate that because of the brevity of this presentation, we might not be able to get through all of the submissions that we've made. Specifically, I timed myself, Chair, I won't be able to get to slide 10 to 12, but those are made available to the committee, and we also have a line-by-line analysis of our written submissions that have been made available to Treasury and SARS and to the committee accordingly. But we'll just kick off with some of the amendments that we'd like to bring to the attention of the Standing Committee on Finance. It might be problematic in terms of attracting, retaining, and growing the South African tax base. We appreciate that we're in a critical week in terms of FATF. A lot of work has been done to make South Africa attractive, both internally and for external people to come and reside here and contribute to direct investment in the country. And these particular amendments we feel need to be brought to the attention of the committee, as they might circumvent the very nature of this intended process. And the first being the exemption or the repeal of the exemption or the removal, proposed removal of the section 10(1)(g) cap C2. Currently, this exempts from South African tax taxing foreign retirement funds. While we understand National Treasury's intention, as that stated in the draft explanatory memorandum, that there is a risk of double non-taxation, and the fact that if there is a right to tax, we forego it, and there might be loss to the fiscus in terms of this exemption, and therefore they're proposing the removal. We also understand that this has been in the works for over a decade now, but notwithstanding this, it doesn't feed to attracting, retaining, or growing the tax base. It also circumvents the EET model of retirement funds, and we appreciate that by removing this exemption upon the very basis that some people who wish to retire or make South Africa their forever home, and part of the consideration is the fact that they wish to invest in the country but do not want their pension funds to be taxed, and the removal of this exemption might deter them from joining South Africa or making this their forever home. Additionally, South African tax residents that have left the country and wish to come back might be discouraged from doing so, so we discourage the repatriation of skilled professionals. We reduce our competitiveness and attractiveness for foreign retirees, and there will definitely be a loss of foreign direct investment. We appreciate that if this does go through, we would recommend that National Treasury have some sort of transitional relief or grandfathering mechanisms. Those that have structured their pension funds upon the premise of the current legislative framework, being that there is this particular exemption from South African tax, should be allowed to continue upon that basis, so that there is legitimacy and certainty in the tax system. And inter alia, we'd be interested to know from National Treasury at brought out at the workshops what exactly supports their data in terms of the fact that there is a loss of revenue. What are the countries that might be impacted? Have they done perhaps some modeling on the impact on migration and investment? So again, just speaking to attaining and retaining talent, this proposed amendment might be a problem. I'll rush through it again. We understand another problem cascaded from Budget 1.0 to 3.0. We know that there was some sort of relief in terms of the freezing of tax brackets proposed in Budget 1.0, but that did not filter to 3.0. And we understand, we've discussed at length in this particular forum inter alia, that taxpayers are stretched. There is the erosion of the purchasing power because there's no reprieve in terms of the frozen tax brackets. National Treasury is now proposing or reducing or making this blanket proposal in terms of Section 20 Cap A, seeking to reduce the threshold of allowance of offsetting of losses made from side hustles or suspect trades as listed, that members or people in general, Honourable Chair, are seeking to augment their income because of the frozen tax brackets, and they will then go into side hustles and seek to generate income therefrom. But now we are squeezing the middle income tax bracket by this blanket provision or tightening here, penalising compliant taxpayers who engage in these trades, not because of seeking to avoid tax or aggressive tax planning, but because they want to augment their revenue. And we would caution National Treasury to target the real risk and not the hustle. If there are examples that can be provided of those in the middle income tax brackets who are abusing these provisions, and just examples of those suspect trades over and above those listed in Section 20 Cap A, that would be helpful. Sometimes it is worthy to mention that the losses that are made and that are offset are not as a result of tax avoidance or aggressive tax planning, but just as a result of declining economic conditions that we currently live in. Another proposed amendment, and we accept and appreciate that National Treasury has again withdrawn this proposed amendment. This had far-reaching consequences, the controversial amendments that were going to be made to Section 8E. Currently, one of the government strategies to empower Black economic empowerment and transformation, preference share funding is utilized a lot upon the premise of this specific section in order not to have the tax incumbent heavily in the hands of the investors. The proposed changes that were made to the section sought to circumvent or to, again, not speak to retaining or attaining or growing the tax base here, because there are certain preferential deals or structures that are premised upon the current working of Section 8E, and the proposed amendments thereto sought to undermine and have a severe impact on inter alia BEE and transformation. We appreciate and welcome that National Treasury has withdrawn this proposed amendment, and we would like to be involved in the consultative processes in order to reach an appropriate solution that will help to again retain and grow our tax base. It's incumbent that we'd also like a response from National Treasury as regards to the use of IFRS in the tax legislation this year. We appreciate that IFRS is indeed broad and very technical. It's problematic. It's not a construct that's made specifically for tax policy, but we see that there's a lot of usage of IFRS, the tax following the accounting, and it didn't work in this instance. So we'd like to know if there's a policy shift from National Treasury. If this amendment does go through in its current form as it was proposed, we would then also suggest that there be carve-outs or strategic carve-outs for, public interest deals and BEE transactions. Another problematic issue, we're all not perfect, Honorable Chair. We cannot reach the state, the styles of perfection. We make mistakes, and taxpayers have got, of course, Section 222 and 223 as it currently stands in order as a safeguard to protect them in terms of the penalties and interest that might be levied by SARS in the event that they make a bona fide inadvertent error. We've got case law to this regard that safeguards and that has inculcated the specific the specific theory in terms of case law. And now we see that National Treasury and SARS are moving away therefrom. We do appreciate, as Mr. Thomas said, did present, that there is a risk to the fiscus if mistakes are made that are quite detrimental. But again, some mistakes are made genuinely, and it is not as a result of, the behavioral aspects that are shown in the table in 223, zoning in here and linking this to substantial understatement penalties, seeking to, penalize behaviors by taxpayers that are just made genuinely, is of course something that we don't recommend be done. There is case law that upholds it as it currently stands, and also the criteria where SARS is appearing to be maybe judge and jury, where they decide what is bona fide and be satisfied in that regard, might be seen as contradictory. And we would request that we desist from, we leave Section 223 as it currently is and as upheld by judicial precedents, and then of course don't penalize taxpayers who operate under genuine faith that they have taken a tax position, they've sought tax advice, and they've then taken therefrom. Honourable Chair, I see I have a minute left. I'll just discuss the last one in terms of Section 12V. Again, the South African Institute of Taxation wishes to bring to National Treasury's attention that there were certain statements that were made by the President at a NAMSA event last year, where we understand that a majority of our vehicles are exported to markets, again, retaining a competitive edge. We understand and appreciate the introduction of Section 12V, but component manufacturers are still excluded from this value chain. They serve as a very integral part in the value chain. Ms. Erasmus did ask me a very interesting question at the workshop to say, if we have the introduction of 12V, why would this not automatically cascade to the OEMs or to the component manufacturers? And indeed, upon further thought, yes, it would cascade, but if there is an uptake from the OEMs in terms of manufacturing vehicles, then the component manufacturers would also need to get some sort of quid pro quo in order for them to build their capacity. And extending this incentive to them would greatly do so, notwithstanding the fact that we understand that there are certain cash grants that are granted by other departments such as the DTIC. Again, we've raised at the national operations meetings with SARS that there are delays in terms of VAT registration letters. That is sitting at the national level, but there are certain proposals in terms of the TALAB where SARS will be inspecting premises. We understand and appreciate that this is to curb fraud from a VAT perspective, but we also understand that there are instances, or we caution that these inspections should not in fact delay the registrations, as currently there is the insinuation that there are those backlogs. So these inspections should not indeed delay the registration of businesses for VAT. It again feeds into growing and contributing to foreign direct investment. I don't know, Chair, of time myself. I've reached the 10 minutes. So I think the committee has our slides available to them to go through the remainder, and we do remain at your disposal should you have any questions or queries.
Thanks very much, Sasana, from site, and also making sure that you stick to the time that has been allocated. I hope your colleagues that will follow the example that you have set. Thanks very much. Let's proceed and invite Saika. Saika, over to you. It's 16 minutes past now. So 10 minutes is allocated to you, 26 minutes. After 9, you should be done.
Thank you, Chair. If we can just get sharing right to bring up our presentation. Thank you.
Hi, Peter. I made your co-host already.
Thank you. morning to the honourable members. Good morning to our colleagues from SARS and National Treasury. Chair, we have a few things that we listed. We'll start off with process and then move on to the technical matters. Obviously, if we can get to the process and enhance the process, we believe that the agreements and arrangements can be better and we can get a better result. The first is a matter of the public consultation. It's something the honourable members would have seen we've raised over quite some time, and there have been amendments and refinements, and we welcome those, including in the Standing Committee of Finance, as well as at National Treasury and SARS. But I think the principles, and we can agree to the principles that we have a representative and a participative democracy. We've already seen how the courts have laid out what needs to be done, and what those procedures are at both the executive and at parliamentary level. So if we currently look at the public consultation, well, given that this is all part of, as was seen in our budget submission, all part of the finalization of the last two acts of the whole round of 5 in the budget, looking at the proposals and where we got, Chair, but I think we also welcome the new fiscal framework discussion, because that's part and parcel of setting the context and the challenges that the minister, and he welcomed us into his house and his challenges, and I think we're not all that far off as we thought we were. What we do think is a challenge is obviously when we do get these budget proposals, there's no response or engagement, what was accepted coming from the Annexure C process. We then see the same bill being introduced into Parliament as what was sent to the public, which to a large extent means that the agreement where there's a meeting of minds from the first engagement between the public and SARS and Treasury, Parliament does not actually benefit from that and seeing what the impact is of that benefit, seeing the same legislation rather than an amended version where the meetings of mind is already incorporated. And then again, once Parliament does the first reading and there are significant changes, then the question is, but where's the consultation in respect of any material amendments, should there be any? If there are none, then obviously there would be no requirement or need for such consultation. So as a recommendation, obviously, this does mean we probably need to move. Currently, the current process has the appropriation bills as step 1 and the revenue bills as step 2, but we probably need to do a bit more consultation earlier in the year, so that we then head into a public workshops earlier with the public, and that we then get a revised bill before that goes to Parliament, so that parliamentarians already get the benefit of what the public has agreed upon with SARS and National Treasury, and that, again, if there are material changes to the first reading, that there is consultation so that the public can then see and have their say on any material changes. The other, this is an informal matter. Again, this is not to put blame or raise concern on National Treasury. Again, we commend Treasury and their efforts and SARS on their consultation. But in the last few years, we've seen that in the public consultations on the public release bills, Treasury have requested that those discussions not be revealed or recorded. And we're questioning the appropriateness in respect of the public documents. And again, because the public need to understand and be able to record and hold to account what is the public stated policy in respect of those matters. In this regard, we do believe that SCOF and National Treasury, given this is an annual process, get alignment of expectations. So what should we be doing in this consultation? What is the benefit of the consultation that moves on? We again agree that there is a necessity for a confidential and closed engagement. It's rather in what we're doing it, in which process, because we do need to be open and frank sometimes, and we believe and we have made previous submissions to Treasury on creating such a platform. And again, so that when we do have public discussions on public documents in a public forum, that it is public recorded what the policy rationale was. So that is recorded. And again, it means that when we come to Parliament, we cannot say we don't know, because Treasury can then say, but here's the document we gave you. So it keeps both parties honest in their representations to this committee. Chair, they move on to some of the technical matters. This was raised by the previous speaker as well, the foreign pensions. I think the important part, this is a project that's been ongoing since we went to resident-based taxation back in 2000, but it was never completed. So there was a lot of things we said we needed to do as government before we implement this. And if we look at it, we saw at that point in time already that there were people settling in here for various reasons. We looked at the taxation of how we treat retirement benefits in South Africa versus foreign, and obviously so that we don't double tax. And again, how do we treat that double taxation and create relief for it? So in this, we request Parliament to consider with National Treasury to postpone this proposal so that the steps as set out in the explanatory memorandum in 2000, that we follow those steps. If we do maintain it, again, that the interventions to ensure that there is no double taxation is in fact done. And the same at that point in time, we said, well, we'll do a 3-year changeover so that people can prepare their affairs. Given that this has now been delayed for 25 years, we'd recommend that we keep at least to that 3-year date of implementation in bringing this in. That exemption and deregistration of schools, Chair, there's been a lot in the media about this, and I think from the public discussions with National Treasury and SARS, there's no malice in this. There's a lot of engagement of saying, but we did not want schools in this area, and we wanted them out for their own sake, not just because there's some nefarious things going on. I think what is clear from discussions is this is not just a private school issue, that's a public school issue as well. And I think that has become clear. There's also, as to the issue of state funding, and that schools are, in fact, even public schools are compelled to seek alternative funding. We already see proposals in this year where certain high-funded schools are already in the public sector being defunded further. So there's going to be more pressure on retaining and getting other sources of funds. So there is a desire to comply, Chair, and I think what we have to also understand that this is a policy change. It's not just, and the reason being why it's a policy change is because we're exempting the whole of the entity, not just its supplies. So again, the big issue is timing, school budgets having been processed, etc. So bringing in this and having a financial impact is of a concern. Public schools are going to be impacted given this, and I think that might be something we do need to discuss. And again, looking at and quantifying this as to what exactly the impact is. And lastly, Chair, the impact of the policy change on other taxable supplies. Schools don't just make educational supplies, they might have welfare activities, they might have other trade. And if we are going to exempt them as entities rather than specific supplies, it has a knock-on effect to that. So I think there is some more thinking to be done on this, and I don't think there is that much pressure that this must be done immediately. The second last issue is on the proposal to amend delivery of notices or legal notice in legal proceedings against SARS. So this is where taxpayers go to the High Court for relief against SARS. I think the background, Chair, to this, there is similar legislation for organs of state in regards to debt collection. However, the provision that's currently in there is a bit wider even for SARS, so it requires notice and where that notice is to be delivered. This is trying to insert a form requirement, which is quite open-ended and quite a concern, given that this is an access to court issue. And even in the current legislation and other government, it acknowledges that in the preamble of that legislation, saying this is a Section 34 and a Section 36 limitation that needs to be considered. It is not, as the EM says, just a alignment exercise. And we recommend that this proposal be withdrawn. Chair, there's then the issue, and I'll go quickly through this one, it's a long ongoing issue of public benefit organizations, and this is a check and balance in making sure that they actually be able to prove independently that the money they get under exemption from the tax system is used properly. The reason why we raised this over the years is that what the assurance that revenue was seeking is mismatched with the process that was in there, and it's now proposed to fix some of that. However, the actual amendment does not achieve this because the actual assurance statement is still, in fact, in the legislation, and that there needs to be a process. Why? Because if you've got a standard price process, it makes things cheaper and also means that the SARS officials can better understand and know what they're getting. The last is already noted by the previous, and I'll finish off with this point, bona fide inadvertent error. Again, this is something that's in addition, so these are understatement penalties, they're in addition to other penalties. And essentially the long and the short here of our concern is we're moving from a system where the taxpayer conduct is going to be ignored, and we're only going to look at a penalty based on a matter of monetary value rather than whether somebody was at fault. as was found in the SEA as a requirement to impose this. And we believe that this proposal should be withdrawn as an additional penalty. And as the previous speaker said, we support keeping it as is. Chair, thank you very much for your time.
Thank you, Mr. Faber, and also sticking to the 10 minutes allocated. Of course, you were here even yesterday. Thanks for coming back. The next stakeholder, PKF. We can see.
Good morning. Good morning, Chair. Good morning, honorable members. Can you see the presentation?
Yeah, I can see your presentation. 10 minutes.
Thank you for the opportunity. My name is Paul Gearing. I'm the chair of PKF South Africa's Tax Committee, and I'll be presenting on behalf of PKF South Africa, firm of chartered accountants, auditors, and business advisors. Why is it not back down? Why is the slide not moving? Shucks. Why is my sharing not working? Can you still see the slides? Okay. My first concern is on the VAT modernization. We're concerned about the process that is being proposed in respect of the VAT modernization, concerned about the costs of the new IT system, the time that it will take to implement that system, and the skills that will be required by small businesses for that system. We are concerned that this will not just be a voluntary system for some of the larger entities, but will be required to be implemented broader. We understand the problem. The problem is fictitious VAT inputs, and the problem then is fictitious VAT refunds. But we think that the proposed methodology is not the correct methodology to use for the implementation of this system to change that problem. We think that if one looks at changing the VAT system for a South African perspective, for a South African problem, one could remove the fraud and one could effectively reduce the VAT rate. We've made further proposals on this in detail to National Treasury, and we wanted to highlight it to Parliament. We are embarking on a system that has not been implemented in the developed countries as yet. It's been delayed a number of times, and yet we are attempting to do it and attempting to implement it over a 5-year period when we have a real problem now, and we believe that there's a methodology to address that real problem now. If one has a look, at the a draft model that we've provided, if one has a scenario of a wholesaler or a retailer, we believe one could reduce the VAT rate to 6% and still have the same level of recovery for SARS, but for the consumer, selling price of goods will in fact reduce, in this example, from 115 Rand to 110 Rand. So we believe that there will be stimulation in the economy. We believe we have a real methodology to cut down on the VAT input fraud down to zero. And yesterday, one of the honourable members spoke about the illicit economy and said the illicit economy is the enemy. In VAT, the illegal inputs are the enemy, and the current systems of SARS are not able to address it. We believe we should be able to address it far quicker than a 5-year program in that regard. We also are very concerned about this change in the bona fide inadvertent error. We find this in conflict with the Constitutional Court judgments of Thistle and the Supreme Court of Appeal judgments in Coronation, and essentially this will prejudice ordinary taxpayers. Currently, those with significantly large understatements, so an understatement of more than R1 million worth of tax or 5% of your taxable income, already have a carve-out provision if they have an opinion and have taken advice on the matter. But why should a taxpayer with a smaller level of error be slapped always with a 25% penalty, which would be the case if the bona fide inadvertent error was to be removed from its current position in the framework. The alternative is to insert a new behavior, which would be reasonable care taken with zero understatement penalty. That would also restore the balance. Because what we're having now is we're having a distortion in the balance in that SARS, who sets the rules, who implements the rules, is changing the rules solely as a result of the Constitutional Court and Supreme Court of Appeal judgments. We find it is wrong that their onus, which they must meet to show the behavior, will become meaningless without the carve-out. We find this amendment of the suspension of payments to be a positive amendment, but we are concerned about the implementation in the e-filing system. Already the law provides that if one intends to object, then one meets the criteria of a suspension of payment. And yet the system systematically rejects such applications on the basis that no objection has been lodged. We feel that whilst the law is correct, and while this amendment to the law is correct, one needs to ensure that the system correctly implements the law. Otherwise, one has a negative position. On the low value of the importation of goods, we are concerned at the delay. Why should South African retailers continue to be prejudiced where those foreign online providers have an undue advantage to their South African competitors? There's no rational reason for the unequal treatment. And once again, it's the system or the inability to change the system that is causing the problem. The other speakers have also addressed the issue of the ring fencing of the losses on the so-called suspect trades. We would say, let's look solely at the aspect of rental properties. Why put this limitation on rental properties? Why inhibit the growth of a middle income group by investing directly in property for rental? Why discourage savings in this avenue? We think that this should not be extended to that category of trade in order to encourage investments. I'm well within my time, and I thank you for the opportunity.
Thank you, Paul, from PKF for the input. Let's proceed to Tax Consulting South Africa.
Thank you very much. Sorry, I see that my camera seems to be upside down.
You are upside down here. Your head is facing down.
That is very strange. If I may then just proceed as this, if that is okay, honourable members. Unfortunately not an IT expert, so we'll not waste any more time than trying to fix that. But if I may just share my screen, then I do thank you all for, again, obviously the opportunity to at least present today. And I will be explicitly talking about the Section 10 Foreign Pension Exemption Amendment. And you can let me know if you can see my screen at the moment.
Yes, you can see the screen.
Perfect. Thank you very much. In terms of this, I obviously have submitted, us as Tax Consulting submitted written submissions. I'm just going to focus on reinforcing or just adding a bit of what we see practically and in terms of the insights that I myself deal with daily in terms of consultations with, firstly, foreigners entering South Africa, and as well as those South African expatriates who have left to work abroad and would love to return, and the kind of issues or how do I say, barriers that this is causing for those individuals. So first and foremost, in terms of foreign nationals entering, we are well aware that there's varying statistics, but in terms of emigration of high net wealth individuals in South Africa, they are exiting at a large amount. If you look at a Henley Wealth Report, for example, there's a projection of another 250 US dollar millionaires leaving the country. Whether they formalize their non-tax residency or not is another story. However, with that already happening, what we are also seeing is, and again, based on that Henley and Partners Wealth for Global report, we are also amongst the top 10 countries who attract these high net worth individuals. I'm fortunate enough to be dealing with both those expats who are leaving to come back, as well as foreign nationals and foreign individuals who are looking to immigrate to South Africa because of what we have to offer. And in terms of what we have to offer, firstly, there are not many incentives in terms of foreigners entering South Africa, aside from just its natural and rich beauty it has. Obviously, it was also an entry point into the rest of Africa and is seen as a more first world country than to operate from and to penetrate the rest of Africa in terms of business. But aside from that, individuals who have spent their working lives planning for retirement, incredibly wealthy individuals, are those who are considering not just one but two jurisdictions or countries to set up tax residency for retirement. So already not having a real incentive for those individuals to relocate to South Africa. The one thing that we do have is an exemption on what they have accumulated and planned for in terms of their retirement. So I'm going to just quickly run through these taxation of pre-residency benefits. This is directly applicable to those individuals who are looking to flock to South Africa, who see it as paradise to retire. A negative economic signal, it is definitely, and from our side, in consultations with these individuals who advise them on the tax implications of relocating to South Africa, when they are hearing about the proposed amendment, it's very clear from their side that this is a material consideration, and that if this is the case, they would possibly rather relocate somewhere else, and obviously a very common one is being Mauritius. So albeit that this is, and I'll touch on it shortly, a transitional period, a transitional section, it has been in effect, like one of our colleagues had mentioned earlier, for approximately 25 years. And with law, the intention to provide certainty after 25 years to implement a change like this is, if I may say, incredibly short notice when we are talking about the kind and type of or manner in which a retirement or benefit operates. In terms of policy consideration, it does definitely, as I've mentioned, detract from us attracting those individuals who look to relocate to South Africa, who have foreign skills, who have a substantial amount of wealth. Lastly, or not lastly, but in terms of data, unfortunately, Treasury and SARS have not provided any such data to indicate that this actual amendment to this exemption is something that will be positive for the country. And just referring to the Davis Committee reports when we were talking about a wealth tax, a wealth tax on retirement is an incredibly tricky policy to navigate. And when we are talking about removing this exemption, which directly relates to a foreign pension, which was addressed in that committee report, without data, it is very hard to come to an agreement that the amendment may proceed, if I can say that. In terms of uncertain fiscal impact, again, without data, we don't know the actual impact. But what I am seeing on the ground, and in terms of the virtual workshop with Treasury and SARS that was held, financial advisors as well as stakeholders who are foreigners from the UK and the rest of the world have indicated very vehemently that if this is going to be implemented, then they, in all likelihood, will set up and leave South Africa. As drastic as that sounds, those are the words that came from that virtual workshop. Long-standing policy and lack of precedent. I have mentioned this. I'm well aware this is a transitional section, but again, for 24 years it has been in effect. And for 24 years, people have planned the rest of their lives based on this exemption and relocating or retiring in South Africa. In terms of it being a very broad affected group, it is, from a general South African's perspective, a great policy because it does not affect the general South African citizen. However, those South Africans who have spent and compromised a lot to work abroad and then unfortunately, in terms of this amendment, do have foreign pension funds through their employment, and return to South Africa to re-trigger tax residency are now also facing the consequence of what this, the removal of this subsection or Roman numeral 2. And that again, from what I'm seeing in consultations and practical effect of it, is that these expatriates from South Africa who are still consider South Africa to be their home and are proud South Africans are then also considering actually not coming back and relocating elsewhere in terms of this. Economic retrospectivity, it is obviously an amendment that is only, if I could say on face value, prospective. However, bearing in mind that retirement funds is something that has been contributed to a person's retirement, but investment over the course of their lives. So an amendment like this does directly implicate retrospectively their contributions to foreign pension funds. And the implementation of this, or removing the exemption of foreign pension funds, then directly implicates what has retrospectively been planned for, such as those contributions. So not that it's intended to be retrospective in effect, it does, however, have that effect. Unequal treatment, and that's fine. Other disadvantages. So in terms of the DTA, I know that the main cause was closing loops in terms of double non-taxation. I do mention, and I mentioned in the virtual workshop with Treasury that and SARS, that there's only a minority of double tax agreements that operate in this manner where there is double non-taxation, and proposed a possible alternative solution, which I'll get to at the end, is rather considering whether those need to be slightly amended or not, in terms of not just then making a blanket covering in terms of just changing our local domestic tax law, which again has a broad effect on those who have invested in foreign pension funds. Again, disruption of retirement planning, I have slightly touched on this. Retirement investment is very different from your normal investments. There's no flexibility in terms of transferability and removal and withdrawals. We are aware that early withdrawals are penalized. Certain sections of your pension or retirement benefits are actually not accessible and cannot be withdrawn in terms of without just cause. Many of those just causes are only retirement or death, for example. So to recalibrate in terms of this exemption is sometimes impossible for those South African expatriates that are returning and those foreign nationals that have spent their lives investing in a retirement benefit. So it is incredibly harsh in terms of impact on those individuals who unfortunately do not have the option to restructure their affairs. And again, I emphasize that retirees are considered a vulnerable section of society, and as we know in South Africa already, a very small portion of us can actually afford to retire. So those who have done what they can to actually get foreign pension funds only because they've worked abroad are now going to be seeing something that was not going to be taxed as now possibly their retirement also in jeopardy. Negative taxpayer behaviors. This is a very important one from my side. We are seeing a large amount of individuals relocating from South Africa, ceasing their tax residency. This incentivizes more South Africans who have left, aside from those foreign nationals who are now possibly not considering to come to South Africa, as well as those who are in South Africa and now confirming that they wish to leave. This will force them to actually cease tax residency, and the implication of that being that then no worldwide income will be taxable at the hands of SARS. So this, in terms of balance of probabilities or balance of positive effectiveness, the economy is going to take probably a bigger hit than what we would recover from foreign pensions. Double taxation risk, I think I have covered well. In terms of deductions, it might, obviously countries operate on different retirement mechanisms. So you get exemptions up front or exemptions on withdrawals. There are going to be conflicts in terms of that with retirement benefits in terms of this amendment. So where previously their contributions were taxed and withdrawals were exempt, in South Africa, triggering tax residency means that their contributions would be taxed as well as their withdrawals, which would amount to double taxation in any event. The need for proportional and alternative relief, I do by all means and fully understand that preventing double non-taxation is a valid policy claim. and is something that is an issue that needs to be addressed. However, a blanket approach is definitely not helpful, and I do emphasize that again, at the end of the day, the amendment to a policy like this should be aimed at increasing our economic benefit. And where we are not going to achieve that by including an exemption like this, then it's not going to serve its ultimate purpose. So alternative solutions are such as partial exemptions.
Fraser, in conclusion,
over time, not a problem. Thank you very much.
you can conclude.
Lastly is just alternative solutions, which is in my written submissions, honourable members. So I conclude and humbly thank you for the time.
Okay. Thanks, Fraser Tax Consulting South Africa. Just share. Over to you.
Thank you, Chair. I'm just trying to share my screen. It doesn't want to share right now. 1 second.
I've given you co-host permission, so just check again.
Okay.
Okay, I'll do it from my side. Just indicate what slide you're on as you go along. Thanks.
Okay, thank you so much. Thank you. Good morning, Chairperson and honourable members. Thank you for this opportunity to address the committee today. My name is Emma Schuster and I'm representing shareholder activist organisation Just Share. Our comments focus on the sections of the TLAB that relate to the Carbon Tax Act, specifically on the provisions for Phase 2 of the tax, which is scheduled to commence in 2026. So the carbon tax was first formally proposed by, we're on slide 3. Thanks. Carbon tax was first formally proposed by National Treasury in 2010 and came into effect in June 2019, so after nearly a decade of consultation and design. And its stated purposes remain as important today as they were then, primarily to incentivize behaviour change within high-emitting sectors that leads to emission reductions, and to give effect to the polluter pays principle, which ensures that those who cause pollution bear its true social and environmental costs, rather than them being borne by the public. And then as an additional benefit, the tax generates revenue that can help South Africa to respond and mitigate the devastating impacts of climate change on our people and economy. Phase 1 of the tax was always intended as a transitional period, a learning by doing. The rate was set deliberately low at 120 Rand per tonne of carbon dioxide, and it was accompanied by a whole range of tax-free allowances, which allowed up to 95% of deductions, which were then to be gradually phased down as industry adjusted. Treasury's early policy documents on the tax were very clear that the goal was to ramp up ambition over time. Next slide, please. But over the last decade, that ambition has steadily eroded. First of all, Phase 1 was extended twice, firstly from 2020 to 2022, and then again to the end of 2025. And the headline tax rate, which was meant to increase annually by 10%, is now only increased by inflation as industry demanded. Next slide. Treasury released its discussion paper for Phase 2 on the carbon tax in November last year. And that paper set out several important, although modest, proposals, including that there would be a gradual reduction in the basic tax-free allowance from 60% in 2025 to 40% in 2030, and then a general tightening or removal of redundant allowances that don't incentivize any real behavior change. And although it didn't go nearly far enough at the time to truly allow for an effective tax rate, it did propose some adjustments for phase 2 that would finally bring the carbon tax closer to its original intention. However, by the time the 2025 budget review was announced, nearly all of these proposals had disappeared. Most crucially, that 60% basic allowance, which is now to be retained until the end of December 2030. And then most of the remaining allowances from phase 1, which is actually between 85 to 95% of those allowances, have been carried over wholesale into phase 2, the majority of which have nothing to do with incentivizing behavior change. So this means practically that even by 2030, the tax will still fail to provide the strong price signal that Treasury itself identified as critical. Next slide. This reversal from the discussion paper to the TLAB provisions appears not to be driven by any evidence or analysis, but simply by sustained lobbying from fossil fuel and heavy industrial sectors. For example, our access to information requests under PIRE showed that between December 2024 and January 2025, the 1 month immediately following the publication of that discussion paper, Sasol held 3 private meetings with Treasury on the subject of the tax. And then in March, the budget review confirmed the abandonment of nearly all the proposals that had meant to strengthen phase 2. At Sasol's, and yeah, an example, a small example, Sasol's August 2024 result presentation, its CEO stated that the company was busy engaging with Treasury and expressed confidence that it would get a successful conclusion. That language that underscores the degree of influence that major emitters believe that they have over the regulatory process. And it's just a small example of how vested interests have and continue to undermine South Africa's long-term environmental and economic well-being in the interests of their short-term benefit. Next slide. Thanks. So our submission goes into some detail, but I'll just highlight our 4 main concerns with the current TLAB provisions. Firstly, that the effective carbon tax rate remains far too low. So just briefly, like taking into account all of the current allowances, the effective rate is about 35 Rand per ton for combustion and then 12 Rand per ton for process and fugitive emissions. That's around $2 and $70 respectively. By 2030, under this current structure, they'll rise to about $4 and $1.30. For comparison, the IMF's recommended price for middle-income countries is $50 per ton. And the High-Level Commission on Carbon Prices has said that a Paris-aligned pathway requires between $50 to $100 per ton by 2030. That makes our projected rates between 13 and 80 times lower than these benchmarks, clearly inadequate to drive any behavior change. Next slide. Secondly, the retention of that 60% basic allowance. That basic allowance was conceived as a temporary buffer to allow firms to adapt to a carbon pricing regime. 15 years later, that rationale no longer applies. By retaining it to 2030, Treasury is effectively providing a blanket subsidy to polluters. And this allowance does nothing to reward efficiency or innovation. It simply entrenches the status quo, and yet it's been maintained for an extra 5 years with no commitment to reduce it thereafter. Next slide. Thirdly, weak penalties for exceeding carbon budgets. So this higher tax rate is the only mechanism for ensuring that emitters comply with their carbon budgets under the Climate Change Act. The proposed rate of 640 Rand per ton of carbon dioxide remains far too low to act as a deterrent. If the higher tax rate for exceeding carbon budgets is set too low to disincentivize emissions, emitters simply budget for it for the payment of the tax. Again, Sasol, as an example, has reported this year in its latest financial disclosures that it expects to face this penalty only from 2039, long after the 2030 global target for halving emissions is passed, and clearly showing that in its current form, the tax is not functioning as a deterrent. There's also no provision for increasing this rate over time. It's not even currently linked with inflation, which at a minimum it should be. Otherwise, the figure will decline in real value over time, turning what should be a deterrent into a manageable cost of doing business. Next slide. Fourth and finally, the risk of revenue loss through CBAM, carbon border adjustment mechanisms. So as our key trading partners prepare for their transitions, South Africa's low domestic carbon price will result in CBAM levies, as is already about to happen on our exports to the European Union. And that means that European treasuries collect the revenue that could and should have been raised here to fund South Africa's own transition. Others will follow. Raising our domestic carbon price would keep that revenue within our borders, supporting local investment and industrial transformation. Next slide. This is not merely a technical issue of tax design. It's a question of whether we intend to continue subsidizing fossil fuels and high-emitting industries, or whether we will align our fiscal framework with our climate commitments, economic resilience, and global competitiveness. Not a single major fossil fuel company in South Africa has a credible Paris-aligned transition plan. And yet they continue to demand delays and concessions, citing their competitiveness issues and policy uncertainty, while completely ignoring the escalating costs of climate change itself, costs which are borne by ordinary South Africans. The purpose of the carbon tax was to catalyze investment in clean energy, innovation, and green industrialization. But at the current rates, with these allowances, it simply cannot achieve that. Next slide. So while we understand that the TLAB largely reflects the budget as it was announced, there are still opportunities to strengthen the carbon tax framework going forward. And we urge Parliament to require Treasury to publish a clear, time-bound roadmap for phasing down the basic tax-free allowance, to adjust the headline carbon tax rate in line with international benchmarks and the latest scientific guidance, to escalate the higher carbon budget rate annually, at least by inflation, to preserve its deterrent effect, to ensure transparent reporting of all engagements between National Treasury and major emitters on carbon tax design, and to work with the Department of Forestry, Fisheries and Environment to ensure that the carbon tax and carbon budgets function together as South Africa's core mitigation instruments, rather than operating in isolation. Final slide. Chairperson and honorable members, the carbon tax is one of the few instruments we have that can directly shift investment and behavior towards a low-carbon, climate-resilient economy. But it can only do so if it's designed with integrity and implemented with resolve. At present, phase 2, as set out in the draft TLAB, risks entrenching the very inertia it was meant to overcome. We therefore call on Parliament to restore ambition to this instrument, to ensure that the polluter pays, that revenue is retained and reinvested in South Africa, and that our fiscal policy aligns with our moral and legal duty to safeguard the lives and livelihoods of present and future generations. Thank you.
Thank you, Just Share, for the presentation. The next item is the item for honorable members to engage the stakeholders who have presented so far, making comments, asking questions. There we are, honorable members. Do we have members who want to make comments or want to ask questions? You can raise your hands on the platform. Dr. Beck, over to you.
Thank you, Chair. I will be brief. I think the presentations today were extremely insightful. I'd be keen for any of the presenters from SITE, Psycho, or others to tell us a bit more about what they think the impact will be on schools with the VAT treatment changing, perhaps what some policy solutions could be. And then just to the last speaker, I think her presentation was very insightful, but I do wonder sometimes some of the language used is confusing to me. They say others will follow what the European Union has done on these taxes, but geopolitically, if you can give some examples of major export partners who is following the European train of thought at the moment. I ask this because I do believe we have to be realistic, and the country I'm living in is in an energy crisis. It doesn't have energy abundance. And I think we need to trade these things off, as she said. But I fear that, we face more energy uncertainty if we're not realistic about the situation that we're in. That's it from my side, Chair.
Thanks, Dr. Beck. Honorable Squati.
Thanks, Chair. Let me welcome the inputs that were made by various stakeholders, Chair. But the first one, which I think is paramount, which has always been coming back, it's the issue of the contributions that are made by stakeholders to either National Treasury or SARS and so on, in terms of whether those contributions are actually taken into account when a policy is actually being developed. I think it's one of the areas that perhaps stakeholders need to, share with us how do they want those to be, shown that they have actually been taken into account, because obviously some of these contributions are being integrated into the development of policy, and not because they will not necessarily come raw as they are. So how do they want it to be shared, so that you would say Meridian Economics, or you say Institute of Taxation, this is your contribution and this is what is integrated into the policy, because I think that would be a little bit both technically but also in terms of policy development, it would just be cumbersome but also not really workable. Secondly, is in terms of the SA Institute of Taxation. No, I've already asked the Institute of Taxation. It would be ASISA. The question is, would the ASISA support minimum posted transaction holding periods and a minimum continuity stake for relief under Section 42 and Section 44 to cap short-term reorganizations? And what period and stakeholder threshold do they deem possible for that to happen? I think those are my contributions, Chair. Thanks.
Thanks, Honorable Squati. Honorable Mazewuka. Before Mazewuka, Honorable Mauta.
Yeah, thank you, Chair. Greetings to you and the honorable members. Greetings to the stakeholders. Let me also take this opportunity to thank the stakeholders for their presentation. I'm going to be very brief, Chair. I just have 3 questions. To tax consulting, I heard him saying the wealth tax and retirement tax is very difficult tax to implement. So can he perhaps, in his own understanding, explain to us what he understands about wealth tax? That's 1. 2, for the larger part of the presentation, he was talking about South Africans who are working abroad and wanted. But I'm not sure if he's aware of the unemployment rate we're dealing with currently in the country. I'm not sure if he's aware with the gap between the rich and the poor, the poverty levels, and all the issues that we are trying to address as a country to make it work and make the future of this country to be bright. I'm not saying we should not worry about South Africans who went abroad and would want to come back, but what percentage are we talking about? Here we're talking about 33% of South Africans. If you go to the youth unemployment, it's sitting at over 60%. And that's the problem we're faced with as a country. And all these amendments are trying to see how we can navigate and make it work for all of us. And so that's my problem with all my questions to him. The last one is on just share. We agree that polluters must pay, but your presentation lacks the implementation. What are you putting on the table that will support your remark that polluters must pay? We agree. Carbon emission is the global problem. But if you look at the contributions of South Africa, it's very minimal compared to other big countries, Brazil, Germany, and all that. So what is it that you're proposing? What proposals are you putting on the table for us to make sure that polluters must pay? That will be all from my side for now, Chair. Thank you very much.
Thank you, Honorable Mauta. Honorable Mazibuk.
Thank you very much, Chair. Chair, appreciating the presentations by stakeholders and cannot overemphasize the importance of the inputs from the stakeholders as we shape our taxation policies. Chair, my first question would go towards ASISA. Can ASISA share any data or member surveys on the incidence of in-species transfers of appreciated listed shares into CIS portfolio under Section 42, Section 44, followed by disposals at fund level? In ASISA's view, does this constitute tax avoidance risk that the proposed amendments are meant to address? And how many such transactions occurred in the last 3 years by portfolio type, by AUM band, if you could just clarify that? And has ASISA ever issued guidance discouraging this pattern? If yes, I would request ASISA to table it, and if not, maybe give us reasons why not. If ASISA views this as legitimate, and what guardrails would you support to ensure neutrality without enabling arbitrage? And my next question, Chair, would be to just share, what is the potential impact of the second phase in the short term, and will it pose a risk for the sustainability of various industries and the South African economy? That's the question I would like to ask, just share. I had noted a question for Saika. Yes. Saika, what level of materiality can you recommend as a standard of SARS to trigger the understatement penalties, the USP you have spoken about?
Okay, are you done, Honorable Mazibuk?
I am done. I'm done, Chairperson. Thank you.
Of course. Thank you, Honorable Mazibuk. Honorable Makubela.
Thank you, Chairperson. Good morning to your good self, Dr. Maswanganyi, my colleagues, the honorable members, and the stakeholders. Chair, I have only one question, which is to the stakeholders. In their view, Honorable Chair, do they think that the proposed tax amendment law strike the appropriate balance between raising revenue, ensuring fairness, and promoting inclusive investment towards development. And then in the same vein, from an investment perspective, do they think that the proposed tax and administration amendments enhance certainty, predictability, fairness, thereby encouraging investment? Or do they think that the amendments raise concerns around the complexity of cost and the risks towards investment? In their perspective, where do they think that these proposed amendments strike a balance? Thank you, Chair.
Thank you, Honorable Mokoena. I see the end of Honorable Squat. Is it, what do we call it? We call it old or a legacy hand?
No, it's not legacy hand. It's a new. I think I left something here that.
Legacy, Dr. Legacy.
Baraki in mouth, legacy or old hand. Okay, over to you, Honorable Scott.
Thanks, Chair. Honorable Mount. Thanks, Chair. Chair, I just wanted to check on Just Share as to whether have they assessed the economic impact of a tax-free allowance being significantly reduced and perhaps finally phased out by 2030. And what would be their assessment in terms of the sectors that would be impacted? Because they haven't alluded anything towards that. Thank you, Chair.
Thanks, Honorable Squatty. Okay. In that order of presentations, let's get the stakeholders to respond. South Africa Institute of Taxation, over to you. Alan, is it the
Jason, it's said that indicated they are unable to attend any further, so any questions I'll put to them in writing. Thanks, Chair.
Okay. Saika?
Thank you, Ranch Chair. I'll deal with the questions as posed, from starting off with Honourable Burke on schools and VAT. I think that the impact, firstly, as we've noted, I don't think there's any malice, etc. There was a policy intent to keep certain things and keep it simple for schools. And I think this background, as Honourable Burke will see in our submission, is that the reality is things from a funding perspective of schools are a lot more complex than was initially anticipated. And that has meant that they've had to do things and funding activities which may not have been originally anticipated, including public schools. And I think the consultation with them, there were consultations with some of the representative bodies for both public and private schools. But again, they have hundreds and even thousands of members, and having a few months and giving them only a limited period, I think there is a lot more consultation to be had. And I think that is the gist of the recommendation is go back to the schools, understand what are these funding activities that they, by necessity, are doing. What is the thing they shouldn't be doing? And obviously, if there are things that shouldn't be happening, those are an enforcement issue. But there are things that are happening, there are taxable supplies, etc. Let's have that discussion and come up with a solution where we aren't just cleaning them out or short, because there's a consequence for the VAT. And I think that's the VAT exiting has a cost to it, and for some schools, a significant cost. And that is why timing is one of the biggest issues when dealing with this. As to Honourable Sekwate's question on policy development and how it's taken into account, members, I think this has come to Parliament a few times. If I think back 2015, 16 already, and the then chair of the 5th Parliament noted that what he would like to see is there's a right not to listen to. There's actually a right to be heard. So how did you take into consideration? And usually that is demonstrated by reasons being given to say, I've listened to what you've got to say. This is why I don't agree with you, or this is why I agree with you. I think one of the challenges we have when it comes to legislation is that even though an explanatory memorandum is prepared by SARS and Treasury, I think one of the commentators rightfully made the comment of the budget is that it's in fact Parliament that drafts the legislation or finally adopts the legislation, and it is Parliament's intention that should be reflected in any explanatory, not Treasury and SARS's. And we see even in the courts, etc., when they try to discern what is the intention of Parliament, they use these documents. But these documents, as drafted by National Treasury and SARS, are not necessarily the intention of Parliament. So I think there are instances where Treasury needs to indicate and respond how it incorporated, but at the same measure, Parliament should be saying, we've listened to you, this is why we have not amended the legislation as tabled, or this is why we have, because we've taken into consideration the following factors. The last question posed, Chair, as to Honourable Kgaleka Mazibuko on the USP materiality. So currently we have, so again, this penalty is in addition. It seeks to penalize somebody for doing something that's either intentional or malicious or negligent to a large extent. So this is over and above the normal penalties and interest that applies. So a threshold, it has two approaches. It has a monetary threshold of R1 million. That R1 million has been the same amount from a materiality perspective since 2012. We spoke about this yesterday in Parliament about certain thresholds not being adjusted, changing policy. Again, this threshold has not been changed, so it's probably now, with inflation, closer to about 1.8, 1.9 million, to say how onerous. And the idea was to say, but even if you weren't intending to or negligent, if the thing is so big, we would expected you to take a bigger. The other materiality is just based on the rest of the penalties based on your behavior. So there are certain behaviors, actual behaviors like gross negligence or tax evasion, and it's based on those at certain percentages of materiality. So as to what a reasonable materiality, we would at least say on the 1 million, the monetary threshold, again, penalizing you for as a proxy for some form of negligence, given the nature of the amount, that the amount at least should be aligned to what it was from a policy perspective when this legislation was introduced, and that it can't be R1 million, because R1 million is half of what it was in 2012. So we've not aligned to the policy of this punitive position. Thank you very much, Chair and honourable members.
Thanks, Saika. PKF?
Yeah, there are three of the questions that I'll address. The first would be on the issue of the stakeholder contributions. We all made substantive contributions and had 2 days of workshops with SARS and National Treasury. One would have expected that the next draft that would be provided to this committee would take into account some of those positional changes that SARS and National Treasury might have taken as a result of those interactions, so that one could then limit these discussions to only the core issues that are still potentially in dispute. On the issue of the materiality for the USP, I think the issue is the behavioral aspects. So if you have two taxpayers, one taxpayer takes advice and has an error of more than R1 million worth of tax, they will have no penalty imposed by taking advice. The next taxpayer also takes advice, but their error is only 100,000 Rand. They will have a 25% penalty under this proposal, and that is not right. They've both undertaken a process of reasonable care and taking advice. Why should the smaller taxpayer be prejudiced as opposed to equal treatment for the taxpayers? And on the question of certainty, fairness, and predictability, I'm not sure that all of the changes in the Tax Administration Act that have been set out meet those criteria. I think many of them don't create fairness, don't create certainty, and don't create predictability, and especially in the ones that we've highlighted relating to the understatement penalty.
PKF, are you done?
Yes, Chair. I think those are the only ones that were addressed to me, essentially.
Okay. Tax Consulting, South Africa.
Thank you very much, honourable members. I think our first address, if I'm correct, was Honourable Galeka Mazibuko. In terms of understanding of the retirement funds aspect and the current economic climates that we are facing, I definitely understand that. And I'm just going to answer your question concisely, go back to the actual purpose that was submitted in terms of media statements, as well as the actual publication of amendments for this exemption to be removed, which was essentially to close loopholes, to avoid double non-taxation. So I understand the current economic climate, but in terms of amending an exemption regarding pension or retirement funds, I don't see that is applicable to the current economic climate in terms of employment. The purpose that was published in this regard was for the closing of loopholes, and not directly implicated to address unemployment. In terms of the mention of wealth tax, etc., I mention it as such because it is a complex and very tricky, how do I say it, area of tax law specifically. In terms of the Davis Committee report, if it's mentioned there that it does need a lot of research or more investigation. It is problematic where we're making a proposal on something to remove an exemption where I haven't seen any follow-up or investigation or information on that topic. Further, administratively, it does also cause a bit of chaos in terms of those South Africans as well, who maybe are not high net worth individuals who are not working offshore, but have been permitted to invest in certain offshore retirement funds that have previously been non-taxable. And as well as those fund administrators who have advertised and marketed their products as non-taxable in South Africa for tax residents. The one aspect that hasn't been addressed is what about those fund administrators, and how do they explain that to their clients in South Africa? As far as the economic climate goes, there is a lot of things that can be done in terms of unemployment. But regarding the exemption of foreign pensions, I don't feel that is a direct solution to an unemployment rate problem, if I may humbly offer that answer. I think the second question in terms of Honourable Makubela was, does it provide certainty, some of these amendments, in terms of which definitely the sentiment and not just my thoughts, but again, just on the daily consults I'm dealing with in terms of expats from South Africa and foreigners looking to enter South Africa, it adds to uncertainty. We are aware that we are unfortunately not being able to collect and hit our collection targets. And for as long as individuals are aware that we are not hitting that collection target, every year the sentiment is that there's going to be more far-reaching implications in terms of tax or an increase in tax. As mentioned, economic climates in South Africa, the middle class and those lower class in terms of economic benefit or economic income are at their bracket of tax. We are already at a small threshold of our population that are paying tax. So the net or the far-reaching implications, everyone's sentiment is that we are aware that it's going to go to further and further offshore, so foreign pensions, for example. But if that's the case now, what is next? And for 24 years, where an exemption has been in place to give until March, the March 2026 to say it's going to be coming into effect, that provides a lot of uncertainty. And if I may, in terms of consultations, I'm getting a lot of concern and severe, how do I say it, nervousness around what's going on in terms of this specific pension exemption amendment, because that's all I have presented on today. So I'd say it does not help any certainty at all in terms of this. And then in terms of investment and in terms of complexity and risk around that, it definitely is a deterrent for individuals to relocate to South Africa to set up business. And to actually set up businesses in South Africa and have, firstly, expats abroad entering South Africa who are skilled, and that can create more employment, if I may bring it back to the first question. So I do think we are fighting a battle, and again, there are narratives which are not true that goes around, possibly around the world, about South Africa, you know. So we are fighting against those types of narratives too. So unfortunately, this does not assist investment inward, if I may humbly provide that as my answer, Honourable Makabela. And I think those were the two questions posed from me. So thank you for your time.
Thank you, Tax Consulting South Africa. Just share.
Thank you. Thank you very much, honourable members, for your questions. The first question was about the CBAM and being realistic about the energy crisis. So, look, as far as I'm aware, there's at least, there's a number of countries that are discussing CBAMs in their parliament that are up to drafting. There's Australia, Japan, the UK, they're all considering this. And to talk about being realistic, we seem to have this idea in South Africa that somehow our concerns, our internal issues are going to exempt us from what's happening globally. And we're going to be able somehow to negotiate our way out of CBAMs and the other implications of a global transition that is happening. But we aren't. Those countries have their own drivers, their own political considerations. They are going to protect their own industries, most importantly. And, because we have an energy crisis, they're not going to treat us specially. And that's already what we're seeing with the EU. So recently in a CBAM workshop with representatives of the EU that are working on the CBAM, it was very clear that our business fully understands the impact of CBAM on their own potential to survive, but that their response is to just kind of say it's unfair and hope that that's going to be enough. It clearly isn't. And instead of sort of using that energy to concentrate on how to prepare and how to respond, we're wasting time trying to cushion our industries in a way that's not sustainable. So the next question was about what policy we are suggesting to enable, to ensure that polluters pay for their emissions. The policy is there. So National Treasury has set out clearly in its proposals, in earlier proposals, just exactly what needs to be done. What we need is to stick to the rational policy, the science-aligned and economic-aligned policy, and to implement it properly. If we use what we have, then that will go a long way to ensuring that that polluters are paying. So, there's carbon budgets. We have carbon budgets under the Climate Change Act now, but these need to be based on a rational system of a country budget rather than, for example, what emitters think that they can get away with. Our tax, we have a tax, it's all laid out. It just needs to be high enough to have its intended effect. That work has all been done by National Treasury. So in my presentation at the end, I did list some short-term suggestions that we think will greatly enhance the responsibility of emitters to pay for their own damage. So there's the higher headline tax rate. Just aligning the headline tax rate with global benchmarks will make a big difference. Removing allowances that don't incentivize behavior change. Why do we have allowances that don't incentivize behavior change anymore, 15 years after the tax was first discussed? And then ensuring that this carbon budget and higher tax rate are working together properly, because otherwise there's a risk that they're operating in isolation. It creates a gap that emitters can exploit. So it's not really a matter of coming up with new policy. The policy is there. And by the way, we are not, our contribution to global emissions is not really that small. We're the 12th highest emitter in the world. And we have the single highest source of emissions in the whole world, the most emissions coming from one place. So we're actually one of the few countries that I think Venezuela is the other, maybe one or two, but there are very few, that has both high levels of emissions and high levels of poverty and inequality. We can't pretend that we're like Africa, which, until now hasn't really had the opportunities to exploit fossil fuels. We've just failed to translate that into outcomes for people living in South Africa. Oh, sorry, to the previous question, there was also a comment about energy uncertainty. And this goes together with my point now that it's not, of course, we have an energy crisis, and nobody here is suggesting that we switch off all our energy right away, all our electricity. But we're in an energy crisis despite having used fossil fuels for over 100 years. And what we're missing is an opportunity here. We have abundant natural resources, energy resources, critical minerals. The tax is meant to incentivize the growth of those industries together with, which will help to solve our energy crisis. Continuing with more of the same hasn't worked for us in the past, and it's no reason why it should work in the future. And then the final question was, there were two more questions, but I'll address them together, about the potential sort of economic impacts of phase 2 specifically, and of increasing the tax overall, and the risk to potential risk to industries and to the economy. So currently, as phase 2 has been designed, it doesn't seem to pose much of a risk. It seems like business are able to incorporate it into their cost of doing business. But that's exactly the problem, because then what purpose is it serving other than just a random additional cost? If it's properly implemented, yes, it does pose a risk to certain industries. Again, that's the point. It's to incentivize transition away from these industries. We have a timing issue now, because there's been 15 years in which industries have sort of had the opportunity to plan and prepare, but haven't done so, which means that now those industries and all the people and secondary industries connected with them are in danger. But there are also certain kind of external realities that we can't just get rid of. There's the transition risk, as we've been talking about with CBAM. There's also the physical climate change risk, which is by far the most important risk to pose to our economy. So yes, the risk is there, but it's exactly the reason for preparing for a transition. And there is, there's a lot of work out there, plenty of analysis on the costs to industry, but more importantly, on the costs of failing to take this seriously. The impacts on jobs in shrinking industries, that's coal, small-scale fisheries, agriculture, and then especially there's a lot of analysis on the lost opportunities from failing to prepare for and invest in new industries. As I said, our energy and our critical minerals could place us in a really unique position, but the longer we wait to do anything about it, and the more lenient the tax and other climate policy is, there's no incentive to invest in those industries. And that's why we get to the point where we are 15 years down the line from a carbon tax, and there has been no growth in it, or very little growth in those industries, as they should have been by now. Thanks.
Thank you. Let's proceed with our program, where we continue to get submissions. The next stakeholder is Assisa. Assisa, over to you. 10 minutes. Alan.
Yes, Chair. Assisa is on the platform.
They are quiet. Assisa, are you there? Or we take you later and request all the
Sorry, it appears that our presenter is somehow been blocked out again.
Blocked out by who?
I don't know, he seems to have disappeared.
Sorry, who's your presenter?
Chris Beneker?
Yes, I've renamed him. He is on the platform.
Okay. Chris, are you having troubles with your system?
Can you proceed and present yourself?
Okay.
Because time is not on our side. By 12 members want to be out of this platform. They are preparing for the sitting this afternoon. There's going to be a long parliamentary sitting today.
Okay, I unfortunately can't share at the moment.
I'll share the presentation. Just indicate what slide I need to move to. Thank you.
Okay, can we move to the next slide? Previous one, please. Okay, just to introduce the CISA. CISA, the Association for Savings and Investment South Africa, represents the collective interests of the country's asset managers, collective investment scheme management companies, linked investment service providers, multi-managers, and life insurance companies. Therefore, as the custodian of a substantial portion of the nation's savings investments, we obviously, our members would therefore comment on the draft taxation laws amendment bill. Next slide, please. There's three significant concerns we have. The proposed removal of the tax relief for collective investment scheme portfolios in respect of asset for share and amalgamation transactions. The proposal dealing with an anomaly in the Act relating to capital distributions by CIS portfolios, and the changes proposed in relation to the taxation of foreign source lump sum pensions or annuities. There is other comments in our written submission, which I ask that honourable members and the chair look at. The purpose of sections 42 and 44, as well as 41, section 41 contains definitions applicable to sections 42, which deals with assets for share transfers, and section 44, which deals with amalgamations. Just like normal companies, management companies administering CIS portfolios, which we all know as unit trusts, which are regulated investment vehicles, use section 42 and 44 to manage their corporate affairs more efficiently and in the best interests of their unit holders. And I think that's very important. What they do is in the best interest of their unit holders. Currently, section 42 and 44 facilitate the corporate actions without triggering CGT for the investors or entities involved, or securities transfer tax for the entity receiving the assets in the transaction. Very important to note that these corporate actions do not result in a cash flow to unit holders, and they do not change an investor's economic position. In other words, they remain invested as they were before. Next slide, please. Okay, so the National Treasury proposal, basically, it clauses 27 to 29 of the draft taxation laws amendment bill proposed to remove all references to CIS portfolios from sections 41, 42, and 44. Now, in the workshops on 22nd September to discuss public comments, National Treasury did suggest that the effective date be postponed to allow for further consultation on the proposals and industry recommendations. As CISA members believe that further consultation should take place and be concluded before any legislative change is proceeded with due to the impact of the proposals, legislation effectively subject to further consultation creates uncertainty, notwithstanding the extended effective date. And that's the reason we're asking for what we're asking. Next slide, please. So the impact of the National Treasury proposal, investors in CIS portfolios will no longer have the relief from CGT, and CIS portfolios will no longer have the STT relief arriving from these provisions. This will adversely impact the long-term savings objectives of investors, as they may be forced to sell a portion of their holdings in the portfolio to pay any tax. Given these corporate actions don't generate cash or change their economic positions. What also might happen is that when investors are requested to approve amalgamation, which is required under law, under Section 44, or to partake in asset for share transactions under Section 42, where their units in one portfolio are exchanged for units in another, the potential tax implications will play a significant role in their decision, and it is unlikely they'll approve the transaction. This will have a significant negative impact on investors in the savings industry if the efficiencies cannot be achieved by the restructure of CIS portfolios. Next slide, please. Removing the rollover relief will also stifle new CIS portfolio entrants into the market and innovation in the industry, as the business risks will be indirectly borne by investors who would be reluctant to consider anything possibly going forward, but the largest, most established CIS portfolios are management companies. Further growth of the industry could be impacted negatively. Jurisdictions such as the UK, Australia, Ireland, Luxembourg offer rollover or deferral mechanisms for fund reorganizations to promote investor protection and market efficiency. So these removals will then place South Africa out of step with global norms, potentially deterring foreign investment in our local CIS portfolios and making South Africa potentially a less competitive jurisdiction as a fund domicile. Next slide, please. Okay, so due to the time constraints, I'm just going to give a little bit more detail on Section 44 transactions. We refer the committee to the main submission for the rationale for retaining Section 42. Amalgamations by law require the consent of the holders of the majority of units in the CIS portfolios, plus the approval of the FSCA. Section 44 transactions are management company initiated. In other words, the investor doesn't initiate them, but he has to vote on them. Just some examples of why amalgamations are necessary: to amalgamate smaller or sub-economic portfolios, to save costs benefiting unit holders, to amalgamate CIS portfolios of similar mandates to simplify a product offering, creating efficiencies, and to respond to changing market conditions like a significant decline in the number of securities available in a market sector. The rest of the justifications for Section 44 are in our main submission, and I urge honourable members to read that. Next slide, please. So our recommendations are that the proposed changes to Section 41, 42, and 44 not be made. In relation to Section 42, instead of the proposed changes, we would recommend that specific targeted anti-avoidance measures be introduced under subsection 8A of Section 42 to curb the specific abuse which National Treasury is concerned about. If that's not acceptable, then we urge the consideration of retaining Section 42 transactions initiated by the management company, in other words, not by investors, and concluded by long-term insurers investing monies in respect of policyholders, and an additional exclusion in the Securities Transfer Tax Act, which is motivated in the main submission. In relation to Section 44, we believe it should be retained in its existing format, as management company initiated amalgamations require approval of the FSCA and the holders of the majority of units, and they are management company initiated, not investor. Proposed wording for our alternative is included in the ASISA submission. Next slide. The second topic that we want to just quickly discuss is capital distributions, and this is from a CIS. It's been proposed that capital distributions by CIS portfolios should be treated as capital gains by amending paragraph 61 of the H schedule and inserting a new paragraph 82A. This will result in any capital distribution being subject to CGT without any set-off of the investor's base cost. So the issues that we've identified in summary are where we're looking at an equity share capital distribution, the current treatment is to reduce the base cost, so you'll have an anomaly between the two. It could lead to unfair tax outcomes for investors if an investor's base cost is high, as taxing the full distribution as a capital gain may overstate the taxable amount. It is not aligned with global best practice, as most jurisdictions adjust base cost to reflect capital distributions, ensuring accurate capital gain calculation. And it undermines one of the core benefits of CISs, which is compounding due to the potential for earlier growth. Next slide, please. Therefore, our recommendation is that National Treasury implement the suggestion that it had in its discussion paper of reducing base cost first to the extent of the cost of the participatory units, and thereafter treating the excess as a capital gain. But with a proviso that this proposed amendment does not apply where the capital distribution itself is taxed in the investor's hands, either as revenue or as capital. Okay, the next slide, please. Okay, so quick comments on the potential taxation of foreign lump sums, pensions, and annuities. The proposed deletion of Section 10 GC2 will from 1st of March give South Africa the right to tax any lump sum, pension, or annuity received by or accrued to a resident from a source outside the Republic that is not from a social security system, if that amount is received or accrues due to past employment outside South Africa, and a double tax treaty does not give the other jurisdiction the sole right to tax the amounts. Next slide, please. Sorry, next slide. CISA members, previous one. CISA members question whether the proposals...
How far are you from concluding? Because you have
about
minutes.
half a minute.
Okay.
CISA members question whether the proposals will have economic consequences for South Africa, which outweighs the current loss in revenue. It will remove South Africa as an attractive retirement location and might cause expat residents to leave South Africa. And the removal of the exemption assumes that the South African resident obtained tax relief on their contributions in the country in which the employment was rendered, or alternatively that the growth in the foreign retirement fund itself was exempted from tax in that country. That's not always the case. So next slide, please. The change will have a negative impact on South African resident retirees who are dependent on the current exemption, who are a financially vulnerable group, may have no other income earning capacity, and will have structured their financial affairs on the applicable legislation at retirement. Therefore, this could place them in a financially precarious position. And last slide, please. So the recommendation is the exemption be retained as is, or if in the alternative, consideration of the following two partial exemptions, that the existing exemptions be retained to assist retirement members who have retired on or before 28 February 2026, and that as the current exemption currently applies to retirement benefits from outside South African employment, they should at very least be alignment with the existing section that gives exemption for remuneration received in respect of services outside South Africa. Consequently, consideration should be given to exempting the first 1.25 million per annum of the applicable retirement benefits where South Africa has taxing rights. Thank you, honourable members.
Thank you. Old Muchwan.
You, Mr. Chairman. Good morning. Good morning, honourable members of the Standing Committee of Finance, members of National Treasury, SARS and stakeholders. Thank you for the opportunity. I'm representing Old Mutual Group. We had three themes that we wanted to talk through. Two of the themes relate to collective investment schemes. We, in the interest of time and at the risk of sounding repetitive, we are not going to go through it. Suffice it to say, ASISA has covered all of the comments that we wanted to make. We would like to place on record that we are supportive of the recommendations made by ASISA, and we hold the same views as ASISA as regarding REACH, as far as the amendments, both amendments, section 4, it's not both, 6 amendments rather, sections 41, 42, 44, and paragraph 61 and 82A of the 8th schedule. And moving on swiftly then, Mr. Chairman, to section 23M and the impact of changes proposed to the interest limitation rules. Mr. Chairman, you may recall that we have presented to the Standing Committee of Finance since 2023 regarding the penal impact of Section 23M, particularly 23M6 on long-term insurers and retirement funds. We thank National Treasury for acknowledging this impact. On the 24th of December, Christmas Eve to be precise, the changes announced through the 2024 Taxation Laws Amendment Act, allowing unlisted REITs the same concessions granted to listed REITs. However, these concessions were subject to regulation. To date, these regulations have not been published. We are also unable, we don't have a date by which these regulations will be published. Informally, we were given to understand that the date would be 31 October. We're unclear whether the regulations will be published by then. Suffice it to say, this is a critically important amendment that has been given effect to, subject to these regulations. And so we are asking for a stopgap measure. We're asking that in anticipation of the publication of the regulations that are referred to in Section 1, the definition of a REIT in the Income Tax Act, we would prefer that the regulations be aligned to JSE regulations, listing requirements, We prefer that the regulations be aligned to JSE listing requirements that are already approved by the Director General of National Treasury for listed REITs. There are 5 requirements that we have summarized on our slide 10. On my side, I'm not seeing the slide very clearly. I'm hoping that you can. Essentially, it's the holding of immovable property at a cost of at least 300 million, retaining debt levels below 60% of its gross asset value, earning 75% of its income from property rentals, either owned directly or indirectly, and having a committee in place to monitor risks that meet semi-annually, issuing a report that the company has met its required minimum thresholds and is expected to continue to do so in the following year. And lastly, appointing a registered auditor as contemplated in the Auditing Professions Act to conduct the necessary procedures to issue a report annually to say that it is satisfied that the requirements applicable to it have been satisfied. Mr. Chairman, moving on to the recommendations made to amend Section 23M, particularly with respect to the definition of interest in Section 24J, we are of the view that it is the inconsistent reference to 23J in 23M is going to cause unintended consequences. We are requesting consistency in the reference to the definition of interest in Section 24J for 23M purposes, consistently to be applied throughout the section to avoid these unnecessary and unintended consequences. Moving then swiftly to the special requirements that we believe are necessary to unlock institutional funding for infrastructure funds. Mr. Chairman, it is common cause that investment in infrastructure is a catalyst for economic growth and job creation in South Africa. Looking back, Government's Reconstruction and Recovery Plan 2020 targeted significant investments in infrastructure and industrialization. The 2030 National Development Plan targets 30% of GDP to be invested in infrastructure, with the public sector investment in infrastructure targeted at 10% of GDP in 2030, and private sector investment expected to grow to 20% of GDP in 2030. All indications are that the total investment to date is well below the NDP 2030 targets and has been declining in the recent past. The World Bank and Development Bank of South Africa published the outcomes of a joint study in 2023. They quantified the infrastructure and spending needs necessary to achieve the Sustainable Development Goals by 2030 that South Africa is committed to, and has put this in the range of 4.8 to 6.2 trillion rands. In its 2024 and 2025 budget review, National Treasury has acknowledged the need to invest in infrastructure. National Treasury has proposed to introduce a flow-through regime to unlock institutional infrastructure investment, which we fully support. It has also committed to releasing a consultation for public comment. Mr. Chairman, this is yet to be published. It's a critically important document again. As recently as June 2025, the World Bank approved a US $1.5 billion development policy loan to the South African government to support critical structural reforms. Our concerns relate to the fact that the interest limitation rules that are legislated through Section 23M do not support fiscal policy on the one hand, and do not align with regulatory changes with the objective of attracting pension fund investments in local infrastructure. Mr. Chairman, we pose a question to the legislature. The first question is an in-principle one, whether it is indeed the intention that the interest limitation rules apply to funding from retirement funds and the untaxed policyholder fund of a long-term insurer. We understand that the intention of the legislature was to address the disparity where a borrower secures a tax deduction for interest costs while the lender is not taxed on the income. A classic example is where the recipient of the interest is a non-resident while the South African is borrower secures deductions. In the case of retirement funds, we are being repetitive, if our previous presentations are recollected, that whilst the fund itself is not taxed, when the person to whom the benefits are paid secures this, it is in fact taxed fully. We are of the view that the intention of the legislature was to tax the member as opposed to the fund. The impact of 23M in its current form is 27% lower returns to the extent interest limitation rules apply, ultimately putting South African retirement funds and the untaxed policyholder fund of a life insurer at a significant disadvantage to other investors, including local banks in infrastructure. Mr. Chairman, moving swiftly, our stopgap measure is that we are advocating for the introduction of certain amendments to Section 23M6. We set that out in detail in our slides. Essentially, we're asking for the removal of the reference to linked units and the date of 1 January 2013 in that section. We're asking for the expansion of the exclusions in 23M to include direct or indirect interest-bearing funding from regulated institutions, such as retirement funds and life insurance funds, and expanding the reference in 23M6 to include infrastructure funds as well as development impact funds. Mr. Chairman, turning to the Global Minimum Tax Act, and this is number 46 of 2024, and the proposed amendments to Section 2 of that Act. Again, on a point of policy, we believe that the global minimum tax serves as a critical safeguard for the South African tax base, ensuring that any effective tax rate below the 15% global floor is topped up locally as opposed to forfeited to foreign jurisdictions. The approach projects South Africa's fiscal sovereignty, curbs profit shifting and base erosion, aligning with the global movement towards fair and transparent taxation. Old Mutual is fully supportive of South Africa's introduction of the global minimum tax with effect from 1 January 2024, requiring all multinational entities operating in South Africa to pay a 15% minimum tax on income earned in South Africa, while taxing headquartered companies such as the Old Mutual Group on global income at an effective rate of 15% in South Africa. We note that the global minimum tax legislation is complex, it is subject to interpretation with no precedent, and the calculation requires significant new data points. Mr. Chairman, we have gone through this for our 2024 fiscal year of assessment. We had to collate 400 new data points for the 434 operating entities in the Old Mutual Group. However, we rely fully on the OECD guidance. The Organization for Economic Cooperation and Development in June 2024 issued pertinent guidance to clarify the complex issue of the so-called recapture rule for deferred tax liabilities and the determination of deferred tax assets and liabilities for global anti-base erosion rules. These are essential in determining the global minimum tax liabilities for multinational entities on a consistent basis. The proposed amendments to Section 2 of the Global Minimum Tax Act, however, prevent multinational entities with a year of assessment commencing pre-30th June 2024 to rely on this guidance. It makes the calculation of the liability not possible in accordance with the Organization for Economic Cooperation and Development rules on which the South African legislation is premised. The impact of not following the OECD guidance, Mr. Chairman, is obvious. I think South Africa will be an outlier on the matter of how deferred tax liabilities are treated when they do not reverse within 5 years. And without reliance on the OECD guidance, this will be subject to interpretation, and there's a likelihood, of course, of inconsistent treatment between impacted taxpayers. Our request, therefore, is that Section 2 of the Global Minimum Tax Act be amended to include a proviso confirming that for the first year of implementation, number one, the OECD Global Anti-Base Erosion Rules, number two, all OECD commentary, number three, OECD administrative guidance, and number four, all safe harbor rules published by the OECD up to 31 December 2024 be applied in the calculation of the global minimum tax liability by impacted parties. Mr. Chairman, finally, we have given an appendix with detailed motivation, particularly on two themes: the restructure concessions for collective investment schemes, which ASISA has presented on and which we support, and the impact of the interest limitation rules, which we consistently have believed has penal impacts on the retirement fund industry and the long-term insurance untaxed policyholder fund, both which are contra the intention of the legislature. Mr. Chairman, we thank you for the opportunity to present our views. We remain at your disposal should you require any further information. Thank you very, very much. That's all from us.
Thank you, Honourable Mushwan. IRFA, over to you.
Good morning, Mr. Chairman, and committee members, and members that have joined the platform. Also to our colleagues at National Treasury and SARS, good morning to you. I'm going to share. Please let me know if I am sharing. So, Mr. Chairman, without taking too much time and too much of committee members' time, given their need to actually be at another forum or at a parliamentary sitting, I just want to kind of position where we are from an IRFA perspective, in particular where we're a not-for-profit organization who's dedicated to members' interests and knowledge of the retirement funds. We're big advocates for retirement fund members, for trustees of the fund, and for other interested stakeholders of the fund, where we actually provide both education and through our collaboration with National Treasury and the regulators, we provide an outcome best suited for members. Our presentation today is extremely short and it deals specifically with some technical corrections that we've actually put into our submissions and which National Treasury is aware of. The first one, we've made this submission regarding nominee independent and the fact that the word that should be used is beneficiary, because that's the word referenced in the Pension Funds Act. We've made this through submissions through the Revenue Laws Amendment Bill. We've now made it again. I guess it's actually whether or not it's something that National Treasury would support. The important amendment that we want to actually talk about today is this definition of retirement annuity, where there was an amendment to actually align this definition to all the other definitions of funds in the Income Tax Act. However, the amendment in the paragraph was not sufficient as a whole. So we understand what National Treasury was doing and why the amendment actually happened, but if you look back in 2024, when the Revenue Laws Bill was introduced, that introduced a two-part system, everybody was on their heels actually trying to get through the legislation and rule amendments and all of those kind of things to actually kind of give effect and implement on that day. So some issues that may have been missed by the industry are now coming to fore because the legislation actually doesn't coincide with what practice is. We have engaged with National Treasury on this issue. CISA was actually a party to those engagements, and we've actually made a recommendation to National Treasury that for this round of legislative amendments, we understand that the amendment to retirement annuity is for alignment purposes, but as a whole, through our NHC submissions for the 2026 tax bill, we will be making submission to align all the definitions of the different retirement funds in the Income Tax Act, so that it actually reflects the position that SARS has actually implemented as of 1 September 2024. There was an amendment to the withdrawal rules from a savings component and termination of employment with values where the value is 2,000 Rand or less. This was a welcome change, a welcome amendment by the industry, but in particular, it related to a person having withdrawn in the same year from the savings component, then actually terminated employment and have a small little part left in his savings component, and the amendment now actually allows that withdrawal. There's slight wording considerations that needed to actually be taken into account. We've made those suggestions to National Treasury for consideration, and hopefully that would be considered. The last technical correction that we have on our agenda for today is this amendment to paragraph 2.1 of the second schedule, particularly to allow for divorce orders associated with tenets of religion. We understand that it was introduced to kind of align what came out in the Pension Funds Amendment Act of 2024. This new provision that was introduced under Section 37D of the Pension Funds Act, National Treasury is now allowed for this in paragraph IA of 2.1 of the second schedule. We understand that it's important because it's a new provision in, and the only reason for the amendment is to actually marry the pension funds legislation with the income tax legislation. However, we had a concern that the effective date is only 1 March 2026, and we suggested that it actually be changed retrospectively to 1 September 2024, when this provision was actually introduced into the legislation, in the pension funds legislation. Lastly, Chair, you've heard this throughout this morning's presentation. It's the proposed deletion of Section 10 GC 2, and I think the question of whether this, we question whether this removal will have economic consequences for South Africa. You've heard various people on this platform or from different associations presenting in detail on this. Our suggestion is that this particular provision needs to actually have more consultation. We understand that it is the intention, but we think that this should be deferred, so it allows us to have more consultation with Treasury before this big change is actually made into the legislation. And Chair, that's all from the RFA. I'm happy to take any questions.
Thank you. Institute of Retirement Funds. The next stakeholder, WWF. Over to you.
Apologies, having some difficulty unmuting. Honourable members, colleagues in the Treasury and SARS, thank you for the opportunity to address you. I'm with WWF, that's the Worldwide Fund for Nature. We've been engaging in carbon tax policy and the Climate Change Act for many years, since the conception, and I'd like to just follow up with this, and I'd start with this diagram, this picture here, which was put together by a community in Hamburg. And it's really looking from their perspective at the two futures that South Africa could pursue. On the left is a sort of high carbon development and the impacts that they're already feeling exacerbated by climate change. And on the right is what the future that they're looking for. And I think that this is very pertinent because, as has been put forward by Treasury, and as we well acknowledge, this carbon tax, which is what I hope to speak to, is key to actually implementing the future that we desire. So we agree very much with some of the provisions of the proposal. The extension of the energy efficiency incentive makes perfect sense because it provides an opportunity for, if you like, a carrot as well as a stick for the private sector to reduce their emissions and to take forward efficiency level, or operational level efficiency. The carbon budget allowance, we're also happy to see this extended just to December 2025, provided it is not extended further. The original carbon budget extension or allowance was to end at the end of the first phase in 2022, was then extended to 2024. And with the promulgation of the Climate Change Act, there's no further need for this because carbon budgets become binding. And also the price neutrality provisions for electricity, using the carbon tax instead of a generation fee would be an effective means of reducing emissions if the price were right, which we will touch on later. And of course, the fact that a lot of the energy generation within Eskom is determined by ministerial provisions rather than through a market measure means that this measure doesn't impact on those operations. So that is a key issue with that provision. And of course, we're happy to see the fugitive emissions aligned with the Department of the Forestry, Fisheries and Energies sort of calculations, but would urge that we use the latest version of the methane impacts from the IPCC, which is higher than what is put into the paper. And just the key issue here, and one that Just Share has already raised, is really, really pertinent. The carbon price recommendations from a large number of studies are sort of illustrated here on this graph in blue. These are the sort of price points at which number of studies, both external, international, and internal from National Business Initiative, recommend the level be set at for the carbon price in order to leverage real change. And you'll note that the sort of the bottom ones there are the actual proposals from within this amendment. The green line is the headline price, which is significantly lower than any of the other recommended prices. And the lower ones are, as Just Share illustrated, the ones including the rebate. So this is less than 10% of the mean recommended value. It is not sufficient to leverage the sort of change that we really need. And I think it's also pertinent to say two things here. One is that where a lot of policymakers talk about CCS as being an opportunity for sequestering carbon, the real costs of carbon capture and storage are over that $200 limit, so well above all of those prices. So until a carbon price is similar to that level, carbon capture and storage is much more expensive and is not an option. So it will not come onto the market. So that's very pertinent. And then, of course, the issue of the carbon border adjustment is very relevant. My colleague at Just Share well illustrated the potential for localizing revenue. I think there is also a point associated with that essentially we will at some point face a step change in carbon pricing because we will have to align with kind of international standards and norms. And the sooner that we start making that move, the more potential we have to adjust it. the iteration or the theory that the private sector is able to do this or will do it on its own is undermined by the fact that we have had this commitment and long-term clarity on carbon pricing and have seen no movement. So I think that it's clear that the price needs to be in place first. And obviously, if we start aligning with the international standards, then we become able to continue to export into international markets. I think also, which is a thing that is pertinent, is that we should consider rather than a lot of the continued rebates that are in there, which don't serve a function, and particularly the trade exposure one, we should consider putting in place our own carbon border adjustment to align with that protects our local industry from cheap imports, but also then allows us to export when our carbon price is aligned. So obviously, the key point here is that the price must be higher, that baseline price, but this tax-free allowance, which was committed to being phased out in the second phase and is no longer, must be removed immediately. It doesn't serve a function, or at least phased out gradually over the next 5-year period. There are obviously concerns from high-emitting companies and their impacts on inflation and employment, but there has been a significant amount of independent modeling from the Presidential Climate Commission looking at low-carbon pathways, from Cambridge Econometrics looking at a risk comparison of local and global development paths, from UCT's Energy Systems Research Group using computable general equilibrium economic modeling linked to this energy pathways, showing that the impacts of a high carbon price of a rapid phase out are overstated. And when we consider the environmental and health impacts, the overall developmental impact of a stronger reduction is positive. And I think it's also very important to say that a faster phase out of within the energy sector from high emitting sources leads to higher employment within the energy sector. These models bear that out. And this is a key issue for South Africa, obviously, when we're talking about our development. There are some other points about exemptions that we have highlighted in our written submission that I would urge the committee to look at. But I think there's also a point about the alignment of our carbon budget for companies and the penalties. And as it is written in this articulation of the amendment, it is highly insufficient. So we're proposing within this, there's a 640-ton marginal marginal rate for emissions above the budget. Since this is not adjusted for inflation, and we have a pathway for the carbon tax rate, this is an effective penalty of only 35% over the standard carbon tax rate. So we have some suggestions for improving the penalty for exceedance of budgets, for strengthening that, increasing the penalty rates to at least double the prevailing rate and maintaining it at that level, or removing rebates over the carbon budget period. And of course, an administrative penalty obviously makes sense, but that would have to be aligned with revenue for a company, because an administrative penalty is much easier for a company such as Sasol to pay as compared with a small pulp and paper mill. And lastly, a point about carbon credits. WWF does support some provision for carbon offsets where there is adequate scrutiny for provisioning, but this must be not allowed across all sectors. It should only be allowed for sectors that have no carbon tax liability. And what's important is that the guardrails must be strong. And we have seen historically that this has not been the case. And we're very concerned that some of the offset provisions as they stand do not meet this. So a comprehensive review of a fifth of all CDM, that's the Clean Development Mechanism credits, demonstrated that only 16% of those were real reductions. So this effectively would mean that we are leading to increased emissions and therefore undermining the purpose of the carbon tax. So we have some recommendations again for how these could be rolled out. And what is notable is that where credits are temporary in nature, an entity must purchase additional credits once that project period is ended. So things like sequestration for the land sector. If the project is no longer operating in that landscape, there's a high likelihood that those sort of removals can be reversed, that trees can be removed or chopped down or burned, land use can change. And also there is a significant onus on having those credits and reversals kept or records kept for those much longer than the standard tax requirements, because we need to see long-term removals. And that means that credits retirements must be kept for a minimum of 25 years to address those long-term risks. And then notably, in terms of additionality, we would urge that large-scale renewable energy projects should not be allowed to earn carbon credits. They're already economically viable. This is now the cheapest form of energy that's coming onto the market. And the real constraints are grid constraints, not the cost of the initial project itself. And therefore, these will go ahead within the private sector, particularly with the removal of restrictions on scale that can be done through NERSA. And so we feel that this is one key additionality, and we see this with all of the voluntary carbon standards as an additionality measure. So the writing in of this into the law is problematic. I have also some answers to some of the other questions that came previously, but this is the key points from us. I think we would really urge that this provision get pushed back to Treasury to be revised and to be strengthened, and that it come back to the committee at a later date. And we would ask that the standing committee consider that as an option. I am available for any further questions, and I would urge the committee to look at our written submission if you have the time. Thank you.
Thanks, WWF. S&A General Trading are not here. So we'll go to the next item of members of the committee engaging on the inputs. Over to you, honorable members, on the second round of submissions. You can raise questions, you can make comments. Honorable Mazibuk.
Chair, let me ask this question again. We had received the presentations in advance, and there's a question that I addressed to Asisa earlier. So now that Asisa has presented, let me re-ask the question. I have requested Asisa to share any data or member surveys on the incidence of in-spice transfers of appreciated listed shares into CIS portfolios under Section 42, Section 44, followed by disposals at fund level. And in Assisa's view, does this constitute tax avoidance risk that the proposed amendments are meant to address? And I asked how many such transactions occurred in the last 3 years by portfolio type and AUM band. So, and also I asked, CISA ever issued guidance discouraging this pattern? If yes, if they could just table it for the committee, and if not, maybe if they can just indicate why not. And to Old Mutual, Chair, my question to Old Mutual is, what is the extent of pension fund allocation for infrastructure development? And does Old Mutual believe that government has robust infrastructure development capabilities to increase project preparation and increase the crowding in of pension funds for the infrastructure they have presented in relation to the infrastructure? Yeah, I think those are the questions I have for now, Chair. Thank you very much.
Thank you, Honorable Sibuko, Honorable Maute, then Honorable Van Rooyen.
Thank you, Chair. Greetings once again to everyone on the platform. Just a quick question to Assisa. Seeing that they represent the collective interest of the country's asset managers, in their records, do we have black asset managers in the country? And how many of those black asset managers are their members? That will be it from my side, Chair. Thank you.
Thank you, Honorable Maute. Honorable Van Rooyen.
Thank you, Chair, and a very good morning to yourself and to all those who are in attendance, members of Parliament, and of course, representatives from various stakeholders. Let me start by welcoming presentation mates. Chair, I only had one question, and apparently that's why I lowered my hand. Honorable Mazibuko read my mind because Assisa in its presentation agrees with National Treasury that we have a serious problem around issues of the abuse that Section 42 is trying to address, But I wanted to understand their comprehension of the severity of the abuse because that have to obviously complement their proposed recommendations, But I think Honorable Mazibuko dissected the question properly. And I think if they respond to your question, that will give me an indication of the understanding or the comprehension of Assisa on the severity of this abuse that National Treasury is trying to cap, among other things, by the introduction of those amendments that are targeted at Section 42. So I think their response to Honorable Mazibiko's question will definitely address my question, Chair. Thank you very much.
Thank you, Honorable Van Rooyen. Let's take responses from stakeholders, starting from Assisa, Old Mutual, IRFA, WWF. Assisa?
Good morning, Chair. Can you hear me?
Yes.
Apologies about the problem earlier. I'll try and answer these questions, and if necessary, I'll also defer to my colleague Angus, who gave the presentation. As regards data on Section 42 transactions, I'm not aware of that Assisa's got detailed data in this regard because members' tax affairs are confidential. SARS would certainly have that data, and neither National Treasury nor SARS have shared any data with us. But if they needed the data and if our members were prepared to waive their confidentiality and provide the data, then Assisa could provide that, I think, during the consultation process. That's regarding the data. Regarding the issue of whether Assisa has given any guidance on Section 42, again, to the best of my knowledge, Assisa hasn't given any guidance. Assisa is not denying that there may well be some abuse. And in our presentation, we did say that, subject to certain guardrails, then specific anti-avoidance provisions could be brought in. Those guardrails revolve around that Section 42, and in particular Section 44 transactions, should still be permitted when they are being initiated by the management company. In other words, not being initiated by investors, but by the management company. And also where a life company is moving for efficiency purposes its portfolio into a CIS, then in those situations, one should still have the tax deferral mechanisms. The reason for that is that the motivation for such transactions, where they are management company initiated or a life company moving a portfolio into a CIS, is not to try and save tax, but to just ensure that the underlying assets are more efficiently managed. So that is the principal reason why CISA is saying if these provisions should not just be removed in toto, but rather they should be replaced with specific anti-avoidance provisions. As regards the black asset managers that are members of the CISA, I'll defer to my colleague Angus MacDonald. Angus, I don't know whether you've got any data there you can share with the committee.
There definitely is CIS managers where the controlling interest is black managed. I mean, I can refer to the recent announcements around Coronation, which showed a significant influence of investment. And in terms of tax avoidance risk, I think the provisions that we've just put, that we've been talking about, where you have capital distributions, that is potentially where tax avoidance could have occurred. So tax avoidance means you never pay tax. But there is provisions being put in place to stop tax avoidance. I think what we are basically saying is, at the end of the day, if there's no change in the economic underlying investments and no cash flows, then we do not believe that people should be forced to sell investments to pay potentially tax. But they should wait until they have been able to make their decisions about when to exit an investment as such. I can also confirm that we don't have data on Section 42 in specie, but remember Section 44 is management company initiated, and usually for operational efficiency and for the betterment of the investor as a whole, all the investors. I hope that answers the questions.
Okay, Old Mushwan.
Mr. Chairman, so the two questions that I believe have been put to us, and correct me if I'm wrong. One is what amount is, or what is the allocation of investment funds towards infrastructure projects by retirement funds? I'd like to refer the committee to Regulation 28 of the Pension Funds Act that limits that investment to no more than 45%. I don't have the statistics of individual funds, but we could do that for Old Mutual if that was a necessity. But 45% of funding can be allocated to infrastructure in terms of Regulation 28. Second question was around the capacity. Do we believe the government has the capacity to follow through on these investments in infrastructure? Firstly, I don't think it's a choice. I think it's a necessity. Secondly, I think business has mobilized sufficiently to give support to government. The World Bank has done similar by approving that loan that I mentioned of $1.5 trillion. I'm just going to get my number out again. And the point is that it can't be done alone, but with the support of public-private partnerships and the thinking and the support that we are getting from the likes of the World Bank, I think the government is well poised to do it. like I said, I believe that it is critical. It is not a choice. It is a sheer necessity. Hope I've answered the question, Mr. Chairman.
Thank you. IRFA.
Chair, there was no questions posed to the IRFA, so we have nothing to respond. The issues were covered by other institutions that were present on the platform. Thank you.
Okay. WWF.
Chair, similarly, there were no questions directed to us. I don't know if I can take the opportunity to add some further points to the Just Share responses to some of the honourable members.
Okay. Which questions do you want to respond to?
I think specifically there was a question from Honourable Sekoati regarding the impact of the phase out of rebates, which sectors would be affected, and a question from Honourable Burke regarding the realism around energy growth.
Okay, you can make an input.
Okay, thank you, appreciated. So I think Honourable Sekoati, the question about whether we specifically have assessed the impact of the phase out of the rebates is we have not, but there has been significant modelling by a number of independent entities looking at that. And obviously, the sectors that would be primarily impacted will be the high emitting sectors. So those include cement and steel, which are developmentally essential. And we are already through the JET process looking at how do we provide some of the means to address those. So some support, if you like, the carrot as well as the stick. But obviously all of our sort of fossil fuel thermal infrastructure for electricity, those are governed, as I have said previously, by not just by this policy, but also by the provisioning from the Department of Energy and the determinations. So those ones would partly be impacted by that, but because there is a pass-through, that would also be a sort of a broader policy question. What is also worth knowing is that in terms of the impacts, obviously there would be pass-through effects to people on the street. And the increase in revenue that can be leveraged from that can also be used to support addressing those. So it can be a very progressive means of addressing inequality as well as addressing the broader question of how do we decarbonize and how do we fit South Africa's economy for the future. And as my colleague from Just Share pointed out, the question also should be the impact of not undertaking these. And there have been some work looking at that and significant potential economic impacts for South Africa if we do not implement sort of a nearer term phase out, which would be supported by the carbon tax. And for Honourable Burke, I think your question about EU, other jurisdictions providing CBAMs was addressed. I should also just add to that Chinese Taipei already has such a law. There are a number of bills in the US looking to do this, although I think we can anticipate abeyance whilst the Trump administration is in place. But I think that most likely subsequent to that, we will see those going forward as well. So a significant proportion of our markets are already doing it, and I think we can anticipate many more doing it over the next 5 years. But the question about sort of realism and the growth of energy is very pertinent. In fact, the sort of the cheapest, and again, this is through a number of the developmental pathways modeling work from the PCC and from the Energy Systems Research Group at the University of Cape Town, the cheapest way to increase energy provisioning is a low carbon route. Effectively, what we have at the moment is a system that provides subsidies to a lot of the higher emitting sectors through infrastructural support and those sorts of things. So a carbon tax would go some way to reducing those subsidies effectively, and would only increase the sort of the potential for building more energy infrastructure that meets the low carbon needs of the future, and, as I've said, would increase employment within the energy sector. So I think a realistic assessment of addressing our energy needs would support a stronger carbon price. And I think there's also the question about realism regarding the impacts of climate change, which has been pushed very much from a scientific perspective, where there's a clear lack of understanding of the realistic impacts there. And this was echoed recently by the Institute and Faculty of Actuaries in London, so who are really concerned about the potential large-scale market impacts of not addressing climate change in the near future, and that sort of the insurance industry's beholdenness to addressing some of those impacts may have significant economic impacts, leading to as much as a 50% reduction in global GDP over the course of the century. But of course, that is a big caveat for South Africa, which is particularly looking to develop.
Okay. Thanks very much. We are coming towards the end of the meeting. Do we have announcements before I adjourn the meeting?
Yes, Chair, thanks. It's just to indicate that National Treasury and SARS will respond to all submissions. That's yesterday's submissions and today's. On Tuesday, the 4th of November, that meeting is scheduled from 9 to 12, also virtual. I'll send out the link to participants, obviously, the day before. Then also just the meeting next week, Tuesday, committee's meeting with the AG, National Treasury and SARS on annual reports. Thank you, Chair.
Thanks very much, Alan. And let me thank the stakeholders for the inputs. They are quite very important to us, and they are highly appreciated. We'll continue to engage with you, as Alan has indicated, when we reconvene to get the responses from National Treasury and SARS. And just to indicate that this exercise is not a mere formality. It is a meaningful process that enables members of the public to contribute to Parliament's decision-making exercise, because the Constitution wants us as parliamentarians to involve the public meaningfully in whatever decision that we take in Parliament. So that's the reason why we have this kind of a platform. And we believe that when we come back on the 4th of November, National Treasury and SARS will respond to all the issues that have been raised by members and by yourselves as stakeholders. Let me also indicate that this matter of decarbonization, ESCOM has also approached Parliament together with SASOL. They haven't done it behind the scenes. There's no veil of secrecy. They raised concern in the manner that government wants to effect the carbon tax. And we have requested our colleagues in the other committees, that is energy and electricity, I think petroleum and electricity, to attend to this issue. I also raised the matter with the Minister of Electricity, Dr. Ramhuba, as to how do we deal with this issue of carbon tax. So we can't just ignore Eskom and Sasol as if they are small entities in the South African economy. They are big players, they are big taxpayers, and they are quite significant in the economy of the Republic. So we have to listen to them and find a solution which is in the best interest of the country. Communities in Mpumalanga, for instance, have been raising this issue of decommissioning, what do you call this, projects where energy is generated, as to what does it mean to them when they are left destitute. You decommission a station, and then people are left unemployed, and there's no more economy in those towns. We have to address those issues where by communities in Mpumalanga and other areas where in the main depending on energy generation as a means which has a multiplier effect in terms of the economies of those areas. So we can't be one-sided in the manner that we look at this issue. All of us are concerned about carbonization, and we want decarbonization, but it must be done in the manner that it suits our policy on just energy transition, because just energy transition addresses 4 issues. It's about decarbonization, it's about economic growth, job creation, as well as energy security. So we must address these 4 issues as a whole and not look at one issue in the exclusion of the others. So we'll adjourn this meeting today. We'll meet again on the 4th, and then we'll engage robustly. Thanks very much, honorable members and stakeholders. Let's meet again on the 4th of November. But us as committee will meet next week to deal with issues of audit reports. Thanks.
Thank you, Chair. Long live the Chair.
Thank you, Chair.
Thank you, Chair, and thank you, honourable members.